Hi, everyone. Thanks for joining us today. My name is Cody Cassidy, and I'm the Marketing and Outreach Coordinator here at GuideStar. We are excited to have you all join us today to learn from our panel of experts from Rebuttable on how to get nonprofit executive compensation right, both in terms of retaining top talent and remaining compliant with IRS regulations. This is a difficult issue to handle, and I hope today will help you get moving in the right direction. And on that note, I first wanted to take a moment to announce that here at GuideStar, we just launched our 15th edition of the GuideStar Nonprofit Compensation Report, the largest scale analysis of nonprofit compensation. Chuck McLean, our Vice President of Research, has been completing this report annually for 15 years, and we're excited to launch our latest edition today. We just published a blog post on 7 key findings from the report that I'm certain you'll find interesting. You can find that at the URL on your screen, which is npo.gs/npocomp. Next, before we begin, I wanted to go over a few housekeeping items. Though we've blocked off a period of time at the end of today's event to answer your questions, we're more than happy to answer them as the event progresses as well. As the old adage goes, if you have a question, it's likely someone else does as well, so we want to make sure to address any and all questions you might have. To submit a question, simply navigate to the Q&A box on the right side of your screen. Depending on your computer, it may not be showing right now. If it isn't, simply look for the Q&A button near the top or bottom right-hand corner of your screen and select it to activate that box. Lastly, don't worry if you missed a point or were unable to write down a note. We're recording today's event, and you'll receive that recording via email within a few days to watch as many times as you'd like. And with that, I'm happy to introduce our speakers today, Jeffrey Tenenbaum and Matthew Journey of Rebuttable LLP, 2 of the nation's leading legal experts focusing on nonprofits. Jeff is Rebuttable Chair of Nonprofit Organizations Practice Group and is also an accomplished author, lecturer, and commentator on nonprofit legal matters. For his work, Jeff has received numerous accolades, including several years among Legal 500's leading lawyers in the not-for-profit category. Joining Jeff today is Matt Journey, who serves as counsel for the Nonprofit Organizations Practice Group. Matt represents experience as both a regulator at the IRS and a tax consultant to the nonprofit community at Ernst & Young. Combined, we have an extraordinary wealth of knowledge available to us today on this complex issue. So without any further ado, let's get started. Jeff and Matt, take it away.
Thank you, Cody, and good afternoon, everyone joining us today, or good morning to those of you on another time zone. Welcome to our program today entitled Getting It Right, What You Need to Know About Nonprofit Executive Compensation. The topic we're going to be covering today is a topic that Matt and I and others in our practice at Rebuttable spend a lot of time working on with clients, counseling both organizations and executives in this area, also defending compensation practices in IRS audits, otherwise known as examinations, IRS appeals, and even in some court cases. It's a very complex area. It's a very, very important area. Every time we've ever done a speaking presentation or a webinar or written an article on the topic, there always seems to be tremendous interest, both on the part of the organizations and on the part of the individual executives, and for very good reason. Just to make clear, we're all on the same page. Matt and I are not compensation consultants. We're not governance consultants. We're lawyers. And we are going to talk about a wide variety of legal and tax issues that come into play in this area, some of which does cross over into some of those other areas. But just to make sure we're all on the same page, we are coming at this from the legal perspective. Also, unfortunately, we only have less than an hour for this program. There's a lot more material than we could cover in a much longer period of time. So by definition, this program is going to have to be a bit compressed, and we apologize for that in advance. We also are going to have to cover a large amount of material in a short amount of time, meaning we're going to have to go a little bit quicker at a faster pace than we might otherwise prefer to. But that's part of the game, and like Cody said, the program will be recorded and available for listening or watching later. In addition, the PowerPoint presentation from today's program, as well as a comprehensive white paper and an article of ours on related topics, will be available to all of you from GuideStar following following the program today, and both of those address a lot of these issues. I wanted to give a quick preview of some other upcoming programs that Venable has on the horizon. Venable's nonprofit practice for about 4.5 years now puts on a monthly program like this, focused on a very wide variety of different nonprofit legal topics. We cover just about everything under the sun. They're all free programs. If you happen to be in the Washington, D.C. area, you're welcome to join us in our offices for lunch and the program. Otherwise, you can dial in across the country or around the world for 90-minute programs from 12:30 to 2 p.m. Eastern Time once a month. On the slide now is a preview of our 3 scheduled upcoming programs. If you're interested, just come to Venable's website and sign up, and love for you to participate and learn more about the very interesting nonprofit legal issues that drive Matt's and my and other of our world here at Venable. Here's a preview of what we're going to be talking about here today. We're going to talk about the consequences of both excessive and inadequate compensation. There are some very important consequences in both directions. At the same time, in order to try to find the right compensation levels for your executives, depending on where your organization is on that scale, there can be a lot of risk, but there also are a lot of things that you can do to help mitigate those risks, and we're going to talk about a lot of those things today. So we're going to talk about how you can protect yourselves by taking advantage of something called the rebuttable presumption of reasonableness. We're also going to talk about incentive compensation, something increasingly popular and more widely utilized in the nonprofit world, but an area that also carries with it some significant tax risk. And by risk, as Matt's going to talk about, we're not only talking about potential risk on the organization itself, particularly in terms of threats to potential loss of tax-exempt status for the organization as a whole, but there also are significant potential penalties on the individual recipients of excessive compensation, individuals who work for or receive compensation from 501c3 or C4 organizations, as well as on the individuals who might approve excessive compensation. Some very important topics we're going to delve into today. And finally, we're going to explain and interpret some recent trends in IRS enforcement in this area. With that, I'm going to turn it over to Matt, who's going to be our lead speaker here today. And just so you know, Matt lives and breathes nonprofit tax law. This is all he does. It's perhaps all he thinks about, except maybe during football season. Matt is a terrific nonprofit tax lawyer who I've had the privilege to work with for a number of years here at Venable. He's had some amazing successes in going up against the IRS in this area, but equally importantly, including for programs like today, he's very good at counseling nonprofit organizations on these very complicated nonprofit tax issues. And with that introduction, I'll turn it over to Matt to get us started. Matt?
Thanks, Jeff. As Jeff mentioned, I am fortunate enough to be able to live and breathe nonprofit tax law, which, in my opinion, just means that my job is more exciting than pretty much anyone else's. But when it comes to looking at executive compensation, the tax issues related to executive compensation, we're looking at more than just the tax law, because compensation is something that affects so many people in so many different ways. And so when I talk about raise these issues with executives of nonprofits or boards of nonprofits, I get several standard questions, especially from the executives themselves. The first question is, who cares? In most people's opinion, the amount that they are paid is a very private issue. And so in their opinion, no one else should really care how much they make. The people work hard, they do their job, they do it well, and they're paid, in their opinion, fairly, and it's none of anyone else's business as to how much they're paid. The second question is, is anyone paying attention? Similar to the who cares, if no one's paying attention, what does this matter? Why is this important? The third question is, what are the risks, both to me and to the organization, if I'm paid too much? No one says that they're paid too much, but if they are, they tend to not believe that there's much risk associated with that. And then from an organization's perspective, no executive has ever asked me what are the risks of inadequate compensation. But from an organization's perspective, inadequate compensation is a very important issue as well. But the first question, who cares? And the fact of the matter is pretty much everyone cares. And in looking at your jobs as executives of nonprofit organizations, pretty much the only thing anyone cares about your job, aside from the people that work at the organization, the board that appreciates what you do, and the individual that you serve in the community, for the most part, all anyone cares about is how much you are paid. And looking beyond the nonprofit world for this, if you think about how salary is discussed in sort of a national media context, when you watch ESPN, you'll see, scrolling across the bottom, X player just signed a contract for X million dollars a year. They don't talk about the work that's done to be eligible or to receive the contract for X million dollars a year. They just say X player, X million dollars a year. A few years ago when the public workers went on strike in Wisconsin because of the Scott Walker recall, Fox News was talking about how the average teacher made $50,000 in Wisconsin, and $50,000 was so unreasonable. Teachers do a lot of work. I don't know if you think $50,000 is reasonable or not, but no one talked about the work that these teachers needed to do. All it was $50,000. That's above the median income for the state of Wisconsin. They're paid too much. Why are they on strike? No one cares about the actual intricacies of your job, but people care about how much you make. And that's true of the IRS to protect against abuses. State regulators are far more involved in this now. Donors look at this issue too. In the media, we see a lot of this on slow news days, and so lots of people care, and this becomes a very important question. But beyond caring, why do people care? Why is this important? From a regulator's perspective, they're looking to enforce charities to make sure that the revenue that charities receive is being used for the purposes that the charity or exempt organization has been exempted from federal income tax for. The donors want to make sure that their donations are being used for the purposes that they're making those donations. If you make a donation to cure cancer, you don't want to know that every 99 cents every dollar goes to administrative purposes or salaries for executives. Only a penny goes to curing cancer. Donors are going to look at this information and make decisions on their donations based on what they're seeing. The media is always just looking for an easy story that'll draw attention, and that's something that they're going to get here. As far as employees, I've seen this several times where employees look to a Form 990 to find out the amount that the executive is getting paid to compare to what they are getting paid. So this is an interesting issue.
And Matt, just to interrupt for a second, the monthly program that we just did here at Rebuttable last week was on governmental investigations, and we had one of the key regulators from the Charities Bureau of the New York Attorney General's office. That office is by far the most aggressive in enforcing charities laws among state attorney general offices. And she was making very clear that every time that they get a complaint about a nonprofit or they read an adverse story in the news about a nonprofit that's subject to their jurisdiction, one of the first things they do generally is go to GuideStar, and this is not just a plug, it's the reality. Go to GuideStar, look at the Form 990 for the organization, and look at things like compensation of the top executives. And that is something, she said, that very much factors into their overall analysis of the organization. Go ahead, Matt.
In addition to the state's attorney generals, the IRS very much cares and is very much paying attention to this and using this information as part of its enforcement activities. There have been more issues raised with respect to executive compensation in the last 10 years than I've seen for decades before that. Also, the IRS has said they're going to start litigating these issues, and they have litigated these issues. We've litigated against them with the IRS. And so this becomes very important from an enforcement perspective as well. Also, this is just, as I mentioned before, on a slow news day. This is something the media likes to look at. A recent issue was with the Tostitos Bowl, the BCS Bowl game, where the CEO, John Junker, was fired, sentenced to 8 months in prison, and though the IRS never showed up, there was a lot of focus on this because of the types of compensation he received and the excessive amounts of compensation he received. And one of the interesting things was that a lot of the focus came because people did not want the Bowl Championship Series for NCAA football. They wanted a playoff system. And so they started bringing attention to this and focused on John Junker based on the information that was reported in the 990. and once again, as Jeff mentioned in the plug, available on GuideStar and available to the public. So they were able to find this information, bring this to the light, and next thing you know, HBO, ESPN, Sports Illustrated are all focused on this issue, and they don't focus on the increase in revenue that the Tostitos Bowl probably had, because it went from the Bowl era to the BCS era, which increased the revenue for the BCS games. But they focused only, almost exclusively, on the benefits and the salaries that John Junker had in the compensation that grew. And then once they saw that and there was that sort of blood in the water mentality, they started looking deeper into this and obtaining certain information. And then they started to find things that was more enticing, I guess, from a media perspective. Reimbursement for lavish parties, reimbursement for expenses at strip clubs. Stuff like that really drew a lot of attention and made it very exciting from a media perspective. And I know that I don't represent all the individuals on this call, but if you are receiving expenses reimbursements for going to strip clubs and having parties at strip clubs, you are likely to find yourself in legal hot water for that at some point if it's ever disclosed, just because it is such a lightning rod type issue. And that is one of the things that's important to understand about compensation. Compensation issues are not just about dollars and cents, but there's perspective to it. As I said before, no one really cares so much about the day-to-day aspects of your jobs, but compensation is something that they will be interested in once that's discussed. Whether it's employees themselves comparing themselves to you, or whether it's outsiders. People always believe that they are qualified to do someone else's job for less money if that person makes a lot of money. Growing up, people would talk about during the dominance of Mike Tyson. Yes, I would get punched in the face for $2 million. I'd get punched in the face for a quarter of that by Mike Tyson. Personally, I wouldn't. I've been punched in the face before. It hurts. I didn't like it, and it was not by Mike Tyson, so I'm not going to do it again. But that's the sort of perspective. If I can find 10 people or 100 people or 1,000 people in the country who are willing to get punched in the face by Mike Tyson for $1 million, there are probably dozens of people who are willing to work your position if it is paid a substantial amount and believe that they can do it for half of what you do. And the other thing to think about is that when the IRS shows up, they have a perspective as well. A well-paid executive at a nonprofit likely makes more money than the revenue agent that is conducting the examination. Revenue agents don't get paid a whole lot of money, and some agents work very hard to not get paid a lot of money, and there's a level of resentment there. And so when the agent shows up, if you make 10 times what the agent makes, they're going to come in with a bias and sort of a thought of trying to get you. An example of that when I was at the IRS was an organization where an executive, the COO, was fairly well paid, but he had years of experience in the business world before moving to a nonprofit. And the organization was, it was a school for developmentally disabled individuals, and then also a program getting them jobs after school and providing housing. And this person, his daughter had a developmental disability, and she was enrolled in the school, and he became more and more involved in the school as she was in the school. And through that time, he eventually took a job there and started working as a COO. And as he worked there, he'd drive his daughter to school every day, and then next thing you know, people couldn't get their kids to school, so he'd pick up a couple kids here and there every day, make sure that they got to school. And eventually his car wasn't big enough, so he got a minivan, and that wasn't big enough. So eventually the school bought one of those huge vans that seat 15 people or whatever, and he got to use it as part of his job position. And he would just pick up kids every day on his way to work. And he told us this story, and I was walking out of the meeting with the agent. And I think, wow, this guy's so committed to the organization that he is a COO and a de facto bus driver just because he wants to make sure these kids are part of this program and at school and really getting the help that he thinks they need. And as we're walking out, the agent turns to me and laughs and says, "Ha ha ha! You hear that? They bought him a car. I bet you they didn't include that in his 990. We can get him on that." And that's the perspective you need to keep in mind when it comes to compensation. You got to understand who is looking at this and why they're looking at this. And that brings me to something that's not really in the slides, but I should touch on. What is compensation? And the answer is almost everything. The use of that car was compensation. Incentive bonuses are compensation for this. The salary, of course. The value of benefits, especially the value of unusual benefits. I worked with an organization where the executives were provided health care insurance for life. And the IRS looked at that and considered whether that was excessive compensation because that was a benefit that was so far and above what people usually think of. And so that's what we need to keep in mind when we're looking at this. And in looking at this, what are the risks of overcompensation? From just a donor perspective, as I said before, if a donor thinks that too little of their donations are going to curing cancer or feeding the homeless, or for other types of organizations for advancing the business interest, the interest of the members in the C6, then they're going to be less likely to be involved in this and make donations and make contributions, become members of the organization. The media is only interested in the article. Employees want to know where they stack up compared to their bosses. In organization executives, the risk of overcompensation is that they may themselves be subject to tax by the IRS, and no one wants that. An organization may be subject to revocation. The revocation come either from inurement, where an insider receives an excessive amount of remuneration, or in private benefit, where the IRS determines that the purpose of the organization was to enrich private individuals rather than serve the public. Another issue is 4958 or intermediate sanctions, and this only applies to 501c3 and 501c4 organizations, but it's a very important issue, so I'm going to spend a little bit of time focusing on this. Under 4958, the IRS is allowed to impose penalties on disqualified persons who receive excess benefits from 501c3 and 501c4 organizations. This is interesting because unlike revocation for inurement or private benefit, where the consequences on the organization, 4958 puts a consequence on the individual that receives the benefit, on the CEO, on the COO, on the individual that receives this, and it only applies to C3s and C4s. As I said, it is only applicable to disqualified persons, which are generally officers, directors, trustees, or individuals who control a substantial portion of the organization's activities. And then it's only applicable to excessive amounts of compensation related to that. What's important about this is the penalties. The penalty for receiving an excessive benefit is done in two ways. First, an individual that receives an excessive benefit is required to pay an excise tax of 25% of the excess to the IRS, and then required to return the excessive portion of the benefit back to the organization. If the individual does not return the excessive amount of the benefit to the organization prior to assessment by the IRS, then the IRS gets to impose an additional 200% penalty on the excess. So the way it works is, in this make-up situation where an executive is paid $10, the IRS comes in and says $6 is reasonable, so you have a $4 excess. At that first level tax, the individual is required to pay $1 to the IRS as the tax, and then return $4 to the organization in the excess. So basically, the person gets paid $10 and then has to give $5 of that away. If the individual doesn't return the $4 soon enough, then you get the 200% tax. Under that situation, you get paid, the individual gets paid $10, pays $1 to the IRS under the 25% tax, and then pays $8 additional to the IRS under the second tax. And so in that situation, you got a $10 payout to the CEO or whoever, and $9 in taxes on that. And this is important to understand because if you are an executive of a nonprofit organization and 9/10 of your salary goes to the IRS, you're not going to be happy. And if you are advising an individual or organization and the CEO has to pay 9/10 of their salary to the IRS, you're not going to be advising them in a professional capacity much longer. You're going to be fired. But the penalties don't stop just at the individual who receives the benefit, but also to anyone who participates. And that includes organization managers or board members who approve the transaction. If a board member knowingly approves a transaction, they may be subject to a 10% excise tax on the excess amount of the benefit as well. So in the situation we just talked where there's a $4 excess, they could be subject to a 40% or 40-cent tax as well. Under the penalty for the managers that participate is a joint and several liability, and it's capped at $20,000 per transaction. But a cap of $20,000 does not ease an individual's concern, or at least they're not happy that it's capped when they have to pay the tax. But there are also risks to undercompensating. And the biggest risk is if organizations don't provide their executives with enough compensation, then the executives are not going to stick around. So you're going to have a higher risk of loss, a higher risk of retention, and then you may not be able to attract the talent that's necessary for the organization to achieve what it's looking to achieve, whether it's providing the best healthcare service or providing the best representation for an industry, whether it's providing the best golf club experience. If you aren't paying competitive compensation, you aren't going to attract the talent that you need to survive. And
Matt, if I can jump in for a second, I think it's really important to stress this, and I do deal with a lot of issues beyond tax law, and I deal with a lot of CEO employment contracts in the nonprofit sector, both representing nonprofits and sometimes even today I spend part of my day representing a CEO renegotiating an employment contract. In not only dealing with those employment contractual issues, but also having spent my whole career working with some pretty large, sophisticated nonprofits, one thing it's become very clear is that you, as a successful, and whether you're a small organization, a medium-sized or a large organization, or hope to grow larger, if you have any type of complexity or sophistication in your world, which most organizations do, and whatever kind of challenges you're forced to face, you need to have some really good top talent at the CEO level and at the senior executive level and all the way down to be able to successfully manage and run and grow and achieve the goals of that nonprofit organization. You just cannot generally do it on the cheap. And yes, people are willing to take pay cuts generally to work in the nonprofit sector versus the for-profit sector, but having spent my whole career working in the nonprofit sector, I can tell you it's a very competitive sector. And there are some very good people out there who have a lot of great success in managing and running nonprofit organizations, but they are not going to accept compensation that's less than their peers. And thanks to entities like GuideStar and the very now public availability and accessibility of compensation data, executives know what the going rate is for organizations that are their size, not only for the CEO but for other senior executives. And if you want to attract and retain those type of people, you need to be able to pay that sort of compensation. One of the things I hope you're going to take away from today's program is not just to get scared about the potential risk of excessive compensation that's greater than fair market value. The reality is, though, that most nonprofit organizations don't seek to push that envelope beyond what is fair market value. They simply don't. They wish they could, but most, except some of the very large organizations, generally can't afford to do that. And so as a result, this is more about helping make sure that you are creating the right paper trail and going through the right processes and steps to document things so that you can be assured and rest comfortably, and your board can rest comfortably, that you are receiving fair market value compensation and not something above that. And if you do that, then you're not going to have to be concerned about all the things that Matt was scaring you about a few minutes ago. Anyway, Matt, go ahead. I just wanted to make sure we put that in perspective.
Yeah, and that leads nicely into the next section, which is protecting yourself. Protecting yourself as individuals, protecting yourself as an organization. And one of the things that I think is important is that if you are an executive or if you're the board of an organization, that the organization doesn't run out and make drastic changes right away. Don't run out and cut everyone's salary. Don't say we're never going to compensate anyone above the 25th percentile now because we're so afraid of this. Because there's lots of protections. For some organizations, compensation of the 25th percentile may be excessive in itself. For other organizations, compensation at the 90th percentile, and we've worked with organizations where the IRS has looked at this and said compensation at the 90th percentile of comparable positions was reasonable. So it's not about saying we need to be at the 50th percentile or we need to pay everyone less than $100,000 or $500,000. That's not what this is about. What this is about, the best protection you can have is by being cautious, developing effective governance policies, and most importantly, establishing a rebuttable presumption of reasonableness, which is something that's provided in the regulations. It's provided specifically with respect to 4958, but it really falls within sort of the best practice for setting compensation and provides substantial protections for organizations with respect to both 4958 and also with private inurement because of the similarities there. The rebuttable presumption of reasonableness is provided by the regulations, and basically it says that if you take certain steps in establishing compensation for individuals subject to disqualified persons subject to 4958, there will be a presumption that the compensation is reasonable. And it's three fairly easy, straightforward steps to doing this. Not every organization does it, but they're fairly straightforward. First of all, the transaction needs to be approved in advance of entering into the transaction by disinterested members of the organization's governing body. So if the COO is entering into an employment contract and also serves on the board, the COO cannot be involved in the discussions or determinations regarding her own salary. It needs to be disinterested members only. If the COO is selling a piece of property to the organization, then the COO cannot be involved in the discussions about that. And the discussions about that in order to establish rebuttable presumption can't occur after the sales documents have all been signed. It needs to be in advance by independent individuals. Second, the governing body must obtain and rely on valid comparability data. And there's a couple of parts of this too. Comparability data. They need to be similar organizations. They can be taxable and tax-exempt organizations. There's no need to have them all C3s if you're a C3 or all C6s if you're a C6. If there are organizations that are taxable entities that are engaged in similar activities or engaged in a particular activity in a similar way that is relevant and makes the position comparable, then that information is valid in making a determination about how to establish compensation for your particular CEO. So it's not just nonprofits, but you have to look at things such as location, things such as responsibilities. These issues are what lends itself to comparability. If you are a 10-employee organization with net revenue in $100,000 a year range, or actually gross revenue in the $100,000 a year range, you cannot compare, and you're the CEO of that organization, you cannot compare yourself to Exxon. You can't compare yourself to the New York Yankees. You got to compare yourself to similar organizations. Similarly, if you are in Dubuque, Iowa, a dollar-for-dollar comparison to LA or New York is also not appropriate. So you got to make sure that you're looking at valid data.
And Matt, if I can just chime in on that, I think the important thing to take away from what Matt's saying is that all of those factors are relevant, and what's comparable and valid comparability data is going to vary based on lots of different factors. Although, Matt, would you agree that if there's one factor that's kind of first among equals, and there definitely are no determinative factors, but the one that we see organizations tend to rely on the most is budget size. So if there's one kind of simple rule of thumb, and it would be dangerous to just rely on this alone for sure. But the size of the annual gross expenses, the annual budget, tends to be used as the #1 benchmark for viewing what are comparable organizations. But like Matt said, there's so many other factors. How many employees? Where are you located? What are your job responsibilities? What unique challenges does the position and the organization pose? All of those sorts of things are very relevant as well.
I would actually disagree with you, Jeff. I think the most important thing is similarity in purpose. Healthcare organizations should compare themselves to healthcare organizations. And so making sure you're looking at organizations that are providing similar activities, because so much of compensation relates to the skills that individuals are expected to have when taking certain positions. And so an educational institution is very different from a food bank. And so even if they're the same size, budget-wise, you want to make sure that you're comparing yourself to the industry. And I think after that, the budget is probably the most important thing.
Yeah, no, I think they're flipped. Yeah, I wouldn't disagree. But Matt, let's talk also for a second about how, I mean, we are on a GuideStar webinar, and GuideStar is a great way to view comparability data from other nonprofits, and using the 990 data that's available on GuideStar and even their compensation report, you can compare apples to apples by looking not only at budget size and number of employees, but similar types of organizations doing similar things, at least for comparing tax-exempt organizations. But sometimes, and this tends to happen more in larger organizations or in organizations that are pushing the compensation envelope, sometimes it is worthwhile, and we deal with them a lot, it's worthwhile to go out and hire a compensation consultant to come in and do a very tailored, specific compensation analysis. And this might particularly make sense if you're an organization that really doesn't have any readily available peers that you can easily find on GuideStar or whatnot. Or like I said, if the board or compensation committee wants some more comfort in knowing that you're using and relying on valid comparability data. Of course, there's a cost to doing so, and sometimes it's not cheap, but sometimes it's necessary and worth it as well. All right, sorry, Matt, I know I'm interrupting, but we got to move it along. We're at 2:40 Eastern time.
The third thing that you need to do is you need to document the decision and the reason for the decision. That is easily done if you have if the board approves it and your board has regular board minutes. Simply approving this in the board minutes is sufficient for that. And if you go through these 3 steps and you establish rebuttable presumption, there are lots of benefits. First of all, the most important benefit is that I've never seen the IRS attempt to rebut the presumption. It is a rebuttable presumption, but every time an organization has established that, the IRS has agreed that the compensation was reasonable. That includes a situation where the organization said, we're going to pay our executive at the 90th percentile based on all the information we have. And the board member said, we want to pay him at the 90th percentile because of factors X, Y, and Z. The IRS came in and said, well, you've established this rebuttable presumption. We can't say whether X, Y, and Z is appropriate for that because that's a business decision. So we're going to take your determination and we're going to say that it was reasonable. So that's the most important thing. It also provides board members with almost absolute protection from the excise tax because you have to knowingly enter into a transaction that provides an excess benefit to receive the manager tax. If you have some data that says this is reasonable, the IRS is really difficult for the IRS to prove that you knowingly entered into a transaction that provided an excess benefit. And importantly, just the very nature of going through those steps, the very nature of looking at what other people in a similar position make, the very nature of having only independent individuals approve the transaction, all of that clearly leads to a more reasonable position. And finally, by establishing a rebuttable presumption, the organization is able to answer yes on this 990 to questions regarding how the compensation is approved and whether or not the rebuttable presumption is used. And that's a specific question on the 990, so it's important to be able to answer yes to that. It's also important to keep in mind that the rebuttable presumption is a presumption. It's not a true safe harbor. So there are situations where technically the IRS could challenge a rebuttable presumption. As I said, we've never seen that happen, but it's possible. Even so, even though it is rebuttable, the benefits of doing this far outweigh the benefits of not doing it. And we've seen lots of problems, and I'll discuss them later in the presentation, that I've got some examples that I just included for your benefit if we don't get to it. But where if you don't establish rebuttable presumption, the IRS is able to take its first step, take its first crack at setting up a valuation. And when the IRS sets up a valuation, the IRS doesn't consider the same way the organization does the responsibilities of the individual, the tenure of the individual, how long they've been working with the organization, even in situations where they've been underpaid for the last decade. The IRS doesn't take that into consideration. The IRS puts together its own report, and its own report is based on trying to determine what's taxable. And so it's important to set up the rebuttable presumption because, one, it provides protection. Two, it establishes a safe, a general good practice. And three, because it prevents the IRS from doing just that and having the first crack and looking at this from a taxability. Professional resources available. It's important to understand that executive compensation is not purely an HR issue. It's not a tax issue. It's not simply a legal issue. So you can't just go to your HR person, your accountant, or even your lawyer and say, help me with this. If you go to your lawyer can tell you what to look for and how to establish reasonable compensation, but your lawyer is not qualified to tell you whether you're paid a reasonable amount. You can go to your HR person. Your HR person can tell you about what they look for with compensation, but they're not going to be able to tell you the law with respect to that or the tax consequences. So in looking at and establishing reasonable compensation, it's important that you look at all the possible advisors, your compensation consultants, legal consultants, and executive search consultants. They can all provide you with an understanding of what to look for and what would be reasonable to pay. The examples that I discussed before, and I don't think we're going to have a whole lot of time to go through them, but I just wanted to show you why this is important. The first example was an IRS examination. An organization was an LA organization. The individual was paid, I think it was in the $300,000 or $400,000 a year. And part of the reason they're paid that much is because the first 4 years of the organization existed, they were paid, they started out being paid nothing, and they got up to like maybe $50,000, and the organization finally got established, and the board tried to catch them up a bit by paying them a higher rates in later years. And so they didn't establish a rebuttable presumption. They're being paid an amount that was about 10 times what the agent was making. And so when the agent came in, the agent had this determination, this predetermination that the organization was paying too much. And so when the agent set up its own compensation valuation report, the agent didn't look at this the way the organization would have looked at it. The agent didn't consider that the individual was paid, was being paid in part for services rendered when they were unpaid that first year, or paid very little in the second and third year. The agent just looked at budget size. The agent did not look at industry or location. And in fact, this organization in LA was compared to, and I listed some of the ones that stuck out: Kokomo, Indiana; Bethany, Oklahoma; Tulsa, Oklahoma; Sioux City, Iowa; Portland, Maine. Sioux City, Iowa may be a wonderful place to live, and if anyone on the call is from Sioux City, Iowa, I'm sure it's lovely, and I'm not trying to insult you. But in terms of cost of living alone, someone in LA should be paid a greater amount than someone in Sioux City, Iowa, because LA is so much more expensive than Sioux City, Iowa. So you cannot compare them on a one-to-one basis, but the IRS did. Additionally, the IRS compared a full-time CEO with other titles, including an interim director title, where we don't know if that person was fulfilling the roles of a CEO or even if they were a holdover. The interim may not mean that they are paid what they would be paid when the organization finds its CEO. They didn't look at the hours individuals worked. They assumed that where any organization didn't list the average hour work week, it was 40 and not anything less. It could have been 0 for all we know. We don't know. There was one situation where the IRS list had an individual where they did not report any compensation for that individual on their 990. The IRS assumed that that person was 0. So if you're looking at, it may have been 10 organizations, it may have been 12 or 13, but if it's 10 organizations, that the average amount of compensation is reduced by 10% by the fact that the IRS took the no answer as 0 without having any data supporting that position. So when the IRS does this, the IRS doesn't put together a valuation report that's necessarily good, but the IRS did put together a valuation report that showed that the individual owed a lot in tax. And the tax that the IRS attempted to assess was in the neighborhood of, I think it was $350,000 because of saying that the individual was excessively paid based on this bad report. But because the individual did not have its own report, the organization had its own report to rebut this, the IRS assessed based on this report. Another situation where we were recently in litigation, and I'll try to be real short with this, an organization's largest donor that supported the donor, most of the donor's activities, told the organization, found out that the CEO's wife owned a for-profit company that provided services to the organization. The donor said, unless you cancel that contract, I'm never going to give you a donation again. That effectively would have put the organization out of business. So what the organization did was they tried to figure out how to make this contract go away. What happened was the organization bought the wife's company, and they bought it for an amount that was $600,000, which was basically what the wife owned when she purchased the company herself. And it was done simply to get out of the contract so that she wouldn't be harmed and the CEO wouldn't be harmed, his family wouldn't be harmed by just breaking even, and the organization wouldn't be harmed because breach was estimated to be about $2.2 million. So what happened was the IRS came in and said, well, because your wife owned this, you could have breached the agreement and your wife never would have sued the organization because your husband would have lost his job if the organization goes under. So the value of that is 0. They didn't include the value of the assets that were purchased. They didn't include, they didn't look at anything. They just said that this was 0, you owe tax on this amount. The IRS issued deficiency for $1.3 million. One of the things that's important to understand is that during litigation, the organization obtained 2 valuation reports, each of which said that $600,000 was reasonable. But the IRS refused to consider that report and said, we don't have to consider it because you didn't obtain the report before you entered into the transaction. In that situation, a rebuttable presumption would have prevented that. Also, the rebuttable presumption, as we said before, is almost uniformly, unilaterally accepted by the IRS as making something reasonable. And so the IRS would not have been as aggressive if there was the rebuttable presumption. But in this situation, they were overly aggressive. And in fact, they were so aggressive that the IRS internal experts said that the value of this was $700,000, which is more than the organization paid. So in assessing the tax, not only did the IRS decide that they did not need to listen to the individual's experts, but they decided they did not need to listen to their own expert and could just assess the tax on top of it. And as a result of this, the individual was stuck in litigation for about 2 years, paying significant legal fees and enduring a whole lot of stress because you had this $1.5 million liability hanging over your head for years. And then a couple weeks before the actual litigation in tax court, the IRS conceded the issue entirely because the IRS knew they didn't have a leg to stand on, but they were rattling their saber hoping for a split the difference settlement. And So there's a lot of pressure that all could have been saved had this individual established rebuttable presumption and protected themselves from the beginning rather than having to fight the IRS in the end. So I went a little bit beyond the 5 minutes I was supposed to, but that's what I have gotten so far. Any questions?
Yeah, and I know we've gotten a lot of questions on the webinar that I've been answering directly to our participants. Cody, I don't know the procedure for taking questions verbally, but one thing I did want to mention while you're getting ready for that is that on the Form 990, there is a question ever since 2008 about essentially whether you use the steps that are laid out in the rebuttable presumption of reasonableness for setting the compensation of your senior executives. And of course, like all questions like that on the Form 990, you want to be able to check yes to that. So even if you're not a 501c3 or C4 organization, say you're exempt under some other category, or even for other purposes, you do want to be able to check yes to that box. So because of that, this has really become a best practice in the setting of tax-exempt organization compensation for executives across the board, and it's something that you really need to be doing. If you're not doing it, there's generally a problem, and there's absolutely no reason not to do it. Not only will it protect the organization, but it will also help you deal with some of those issues that we talked about earlier, such as the risks of undercompensating your executives. One of the great things about looking at things like Form 990 data on GuideStar or their new compensation report or other compensation reports or whatnot is that you get a sense, if you're doing appropriate comparability analysis, what is the going rate for executive of organizations like ours, our type of organizations that perform our type of function of this size organization in this type of cost of living area. What's the going rate for executives like that? That's a healthy process for the organizations and for the executives, and it'll help protect you from a tax perspective and help make the organization look better by checking the right boxes on the Form 990. Cody, other questions?
Sure. So we have a question about trying to figure out that compensation level when an organization is expecting budget changes over the next year, significant changes over the next year that would perhaps push them to a different bracket to compare to.
That's a good question. One of the things that when I spoke earlier about the organization that paid at the 90th percentile, the 90th percentile was established by an independent compensation consultant. The compensation consultant came back and said, for an organization in your industry with your budget, in your location, this amounts 25th percentile, this amounts 50th, this is 75th, this is 90th. One of the reasons the IRS agreed that the 90th percentile was reasonable was because when the board approved the compensation, they listed the factors that they considered in approving the compensation. And so what an organization in the situation where they expect either a budget change that will cause an increase in their annual budget or a significant decrease in their annual budget, when they look at this, they should compare themselves to organizations where they expect to be. And then in the minutes where they explain the reason and the basis for their determination regarding compensation, the organization should say, look, we've got this transaction is going to happen on X date, and once that happens, our budget goes from $10 to $20, and because we're looking at compensating the individual next year when we're a $20 organization, we need to compare ourselves to those organizations, and therefore we're going to establish our compensation on the basis of that. And so as long as it's documented, the reasons for the reasoning are documented and they're based on data, the organization will be able to protect itself and establish a rebuttable presumption moving forward.
Yeah, and in addition to that, I mean, that speaks to the issue of, how do you defend it from a comparability perspective. But kind of the flip side of that is, how do you structure a compensation arrangement to fairly compensate and reward the executive when an organization is on an upward growth path, like obviously most organizations hope to be? And of course, one way to do that, we see it all the time, is through bonuses that are based on performance, either based on some rigid formulas or more generally based on the organization's and the executive's performance. But another kind of related way, and these obviously overlap, is more incentive compensation generally, which sometimes can involve bonuses and sometimes can involve other things. Matt, aside from the comparability, defensive issues, any other points you want to make about incentive compensation generally? That was one of the things that we said we'd talk about. I don't think we really got into it too much. But any kind of the biggest pitfalls or biggest things to keep in mind when structuring incentive compensation arrangements for nonprofit executives?
The two biggest issues I see, and the two biggest things I like to see with incentive compensation, or I guess maybe the three biggest things I like to see with incentive compensation, are one, that the incentive compensation is based on quantitative measures to the greatest extent possible. If the board just says automatically approves a bonus at the end of the year just out of course, the IRS is going to question that bonus and question whether or not it's truly earned. But if there are quantitative measures that tie the incentive compensation, whether it's growth, whether in terms of budget size, whether it's individuals served in the community, whether it's membership size in terms for membership organizations, whether it's development funds, whatever it is, if you can tie the incentive compensation to actual quantitative numbers and say if you achieve this much, you get Y dollars in return, then the IRS has to come in and say, well, look, we don't agree with your business decision that achieving X is equal to a value of Y. And it's very difficult for the IRS to question a business decision because that's not the IRS's job. And so by tying it to something like that, you're providing yourself with an extra layer of protection. The other thing I like to see is a cap. If it is just a pure incentive compensation that doesn't have a cap, if you achieve X, it goes up. If you achieve Y, it goes up, and you just go up to potentially infinity, even if it's unlikely that you'll ever get to infinity. The IRS will take the position that it's purely revenue sharing, and the IRS doesn't like revenue sharing and is likely to treat that as potentially an earnment or a private benefit. So even if the cap is way up high in a realm that there's no way you will ever be able to get to that cap, by having a cap on there, you're really protecting your organization and protecting yourself from having issues with the IRS. And the last thing I like to see is a process that requires, one, the board approve the program prior to implementing it. So at the beginning of the year, whether it's the employment contract, every year you're entitled to this amount of incentive compensation to achieve these measures. But I also like to see it at the end of it, where the board says, commemorates in the minutes, yes, this individual achieved X, Y, and Z, therefore, according to the compensation plan, they receive this amount in return. And that second level of approval just adds another layer of protection prior to payment. So those are the three things I like to do with incentive compensation.
Okay, other questions? And by the way, Cody, as I'm sure you're seeing, a number of people are asking about the recording of this presentation. I know that you guys are recording it and you're going to have it available on your site. And if you could also make sure whatever follow-up email goes out later today or tomorrow that it includes a link to where people can find that recording. And in addition, as you can see on this slide that's up there now, all of the monthly programs that I mentioned earlier that we've been doing for almost 5 years now are available both on our website and on our nonprofit YouTube channel. And Matt and I have done at least 2, if not 3, programs on nonprofit executive compensation issues that deal with some of these issues, but some other issues as well. So you can find recordings there as well. Cody, other questions?
Sure. So I think we have time for maybe one more question just to make sure everyone has a chance to carry on. We do have lots of questions coming in, though, so Jeff and Matt, if you wouldn't mind, as you've done in the past, we might do a follow-up blog post, or we'll find a way to get as many answers to these questions, some really great questions, in as possible. And whatever we are able to do, we'll include in that follow-up email with more instructions. And as Jeff said, you will absolutely get an email with a link to the recording. of today's presentation, as well as the slides and a couple of helpful articles to kind of refer back to. So I guess kind of one quick question to wrap up this conversation. Is there a quick and easy rule of thumb that an organization can use to determine CEO compensation, or is this conversation just necessarily far more complex than that?
I think go ahead, Matt. You go first, and then I'll answer.
Unfortunately, I think it's far more complex than that, because the factors that go into setting compensation are so individualized. In fact, if I would generalize, the area where I see excessive compensation, the fact pattern where I see this come up the most, isn't an organization trying to siphon money off to an individual, or a CEO that's just incredibly greedy and trying to take all the money in the world. Where I see this happen most is an individual who works at an organization, who worked there for 40 years or their entire career, and they're just committed to whatever the organization does. And as part of their commitment for the first 39 years of their career, they were able to take whatever little salary they had to make sure that the organization was able to have as much money for accomplishing its purpose as possible. And then in the 39th year, they realize, oh my God, I got to retire now, and I've got nothing because I've never been paid much. And so in that last year, the organization's board of directors, because they love this individual, because this individual has done so much for the organization, says, we're going to give you your last year's salary plus X, Y, and Z dollars just so that you can do this. But they don't ever say why they're doing it, and they don't say why they're why it's important that they want to provide this individual with these protections that the additional revenue provides. And so it's difficult to provide a simple rule of thumb, because in that fact pattern, what they want to provide for that individual may not necessarily be easily demonstrated in a valuation report. It's difficult for a valuation report to take into account 30 or 25 years or 40 years or 10 years of service at a lower compensation rate. And so it's important, what you really need to look at in every situation is the individual position, the individual's contributions to the organization's position in terms of budget and activity, and you need to look at all that. I wish I could provide a general rule of thumb. I wish I could tell you, if you pay at this percentile, you will always be safe. Unfortunately, I can't, because every situation is different and every organization is different.
And finally, this is Jeff. To add on to that, I certainly couldn't agree more. Just a couple other kind of ancillary points to mention. And first, Cody, I thought you were reading a question that said, is there a good rule of thumb on how often you should do a compensation analysis? Which is also a very good question, also a question to which there is no one-size-fits-all answer. And I think there the question was focused on kind of a specifically commissioned compensation analysis. All I can tell you is that what seems to be a best practice is that organizations that do commission those sorts of studies generally do not do that every year. It's expensive to do so, and I think Matt and I would say that's probably not necessary unless you're really, really pushing that compensation envelope heavily and things are changing a lot. But assuming there's not a lot of changes, dramatic changes in the organization size and the compensation size of the executive and whatnot, having those done once every other year or once every 3 years tends to be a good practice. And like we said earlier, you don't necessarily have to do that at all. It depends on whether you're pushing that compensation envelope. But in the intervening years, you definitely need every year to be doing some sort of comparability analysis, even if you're doing it on your own, relying on data from published reports and GuideStar and things like that. But the other thing to keep in mind is an area where we see a lot of nonprofit organizations kind of dropping the ball in this area is that when they think about compensation as just being the salary of the executive or maybe salary and bonuses, but they're not counting perhaps deferred compensation if there is any deferred comp, and or they're not counting other benefits that are not what we call working condition fringe benefits. They're not just things like reimbursement of business travel expenses, but there are other things where there may be a business component but also a personal component. And where there's a personal component, whether it's the provision of a car or, membership dues to a downtown luncheon club or country club, or any number of things that have a personal benefit as well as a business benefit, those things have to be treated as compensation as well. And in fact, for a C3 or C4 organization, if you do not treat those things as compensation, there's something called automatic excise benefit penalties that can apply and automatically impose those intermediate sanctions on the value of those benefits provided to executives. So it's very important that you do a holistic approach at all of the various forms of compensation and benefits that are being provided to the executives of the organization. Obviously, things that are excludable from income you can properly exclude, but anything else needs to be treated as total compensation for comparability purposes. So with that, thank you, Matt, for a great presentation. Thanks, Cody and GuideStar for the opportunity to do this, and we'll turn it back over to Cody.
Yeah, great. Thanks, Jeff and Matt. This was incredible. And thanks to all of you for joining us today. I hope you found this information as informative as I did. We covered a lot today, so as I mentioned before, you'll receive an email within 48 hours with a link to the recording of today's event to refer back to as needed. That email will also include the slides from today, as well as some helpful articles from Rebuttable, and hopefully some follow-up answers to more of your questions. In the meantime, please feel free to reach out to myself if you have any questions about our compensation report, which can help with your efforts to establish that rebuttable presumption of reasonableness. You see my contact information here, and you'll also receive that follow-up email from me. And here again is Jeff and Matt's contact information if you have any additional questions. So with that, thanks again, everyone, and have a great rest of your day.